Brian, I think the focus here continues to be on stocks, and mainly that no matter what vibe the market has about the virus, apparently it still goes up. The stay-at-home trade works when we need it to, and when it doesn't, all the other stuff works. How long can we be in this perfect scenario, this win-win apparently?
Well, look, I mean, I think over the long term, we are going to be in a nice backdrop for equities because we are going to be in a low interest rate world with a very slow economic recovery for a long period of time. That doesn't mean that there won't be volatility or, range-bound markets for a period when, we deal with what we've been dealing with in the last few days around this disconcerting rise in cases. I think it really comes down more to how you want to be positioned as an investor. I want to be exposed to equities for the long term. Which parts of the market do I want to be exposed for? The widening of breadth to the early cyclical small caps value felt a little premature to me. So I'm not entirely surprised to see leadership return back to where we were for really the 10 years after the global financial crisis and for a lot of the COVID-19 outbreak.
Brian, how long can the NASDAQ be this support pillar when over the last 2 months, though, we're seeing the importance of the reopening of the economy and what it means for just about all the main cyclical groups of the market? Because if those are tied so closely to our economic hopes, then I would imagine that if they're going down, it probably means our economic hopes are slimming as well. Do we need to get another dose of fiscal stimulus to justify the market staying afloat? Do we need to see the viruses go back down? How long can we rely on that tech trade? Because eventually, if people do permanently lose their jobs, I mean, tech companies are selling to businesses. If those businesses close, it should be trouble.
Yeah, that's right. And look, we need to get reopening policy right, and we need to get fiscal policy right. And that should ultimately enable a recovery to emerge. So don't get me wrong, there will be a moment as we progress through this where the recovery starts to take greater hold. I think betting against that is betting against policy and betting against human ingenuity. My point is to say, in the near term, as we struggle with cases rising and struggles around reopening, you probably return to this environment where investors continue to favor the true growth companies. At some point in this year, as we progress through this, I think the recovery takes greater hold. The transition goes back to where we were a few weeks ago with a widening of breadth to the cyclicals, the small caps, the value oriented. Ultimately, how do we want to be positioned long term? I'm still in that, that long term structural growth trade. I believe that what this outbreak has done has accelerated a lot of the structural changes that were taking place in society. I don't think we're going to a place, 2, 3, 4, 5 years from now where growth is accelerating meaningfully, where there's inflation, where there's interest rates rising. To me, it's going to be a slow growth world, benign inflation, and we're going to continue to have to pay up for growth wherever it exists.
Brian, 2 points here that I like in your notes that have also been a really important theme we've been talking about here on the show now is just the amount of de-risking, as you put it, the bears that built up from March to basically May until the signs show they started to turn around a little bit and kind of chase the market here. How much of that chase is left for folks that piled into money market funds, that piled into treasuries again? Is that just the simplest explanation, that there's still a cash wall that's being deconstructed the higher the market runs?
Yeah, I think that that chase continues. I mean, we saw money market assets in the mid 3 trillions climb to 4.8 trillion and it's held pretty steady. So, unfortunately, when you de-risk your portfolio, the biggest challenge is then figuring out when to re-risk your portfolio. And there's a lot of skepticism about, the broad economy. There's a lot of skepticism about this market. And so I suspect it's going to take a long time for investors to come back in. Oliver, if you think about what had happened in the aftermath of the global financial crisis, we still had massive inflows into bond strategies until 2013. Every year you would see more Americans play the lottery that invest in equity markets. So I think this is even going to be worse than that. It's going to be a long time of money slowly coming back in, and quite frankly, that's a good sign. I think not a great sign for investors' portfolios, but a good sign that we're probably in the beginning of a next long cycle where policy is going to be accommodative, money is going to slowly come in skeptically over a long period of time. And, equities can do well in that environment, and credit can do well in that environment. So that's how I'm positioned. That's what I expect will transpire.
You have a chart, Brian, just kind of illustrating the different styles of adding into stocks and the different methods to do it, advocating for dollar cost averaging. Walk me through just how that continues to work here. Is that just basically saying, hey, don't be afraid of the market going up, just take it piece by piece?
Yeah, actually, my point was to say that maybe dollar cost averaging is great for your emotions, and it's a nice way to to get back into the markets if you're really concerned about doing so. My point was just to say that it's not always the most advantageous. After the financial crisis, you were actually better off just investing the money rather than dollar cost averaging. One of the examples I like to use is in 1987. If you had put $100,000 into the market on that Friday, by Monday evening it was $75,000. Today, if you did nothing, it was 2.3 million. If you had dollar cost average in the aftermath of that, you didn't do as well. So dollar cost averaging, again, great for your emotions, but not necessarily the most advantageous in most market environments. It's time in the market that tends to matter more.
Yeah, interesting. So at this point, do you have to have a big view on whether or not this market's run, quote unquote, too far, if it's disconnected from the fundamentals? It seems like what you're saying is to basically focus on the more clear outlook for fundamentals, which aligns with tech and aligns with growth and secular growth.
Yeah, I agree. Focus on those businesses that you think are going to continue to do well in this environment, and then will evolve society, evolve the economy, evolve markets over time. Whether or not you've seen markets run up a bit too much in here probably becomes immaterial to investors with a multi-year time horizon. And so, yes, it's possible that you may have some volatility in here. You may have some drawdowns in here. I mean, that's that's the way markets go. But over the long term, I think betting against markets here is betting against policy, betting against medicine, betting against science, and really betting against reopening, where we have seen, whether it's in Southeast Asian countries or the New York tri-state area, that human behavior makes a difference. And we can start to re-engage with the economy, maybe not to the full extent that we want to, but we can begin to re-engage if we take the necessary precautions and protect the segments of the population that require it. And so over the course of the remainder of this year, I suspect we will continue to do so.
Brian, how long do you think we can go without a rush from policymakers to start talking second dose? Is the market and investors assuming that if things get rough, the fiscal side will be there, or is that becoming increasingly a gamble on policy?
Yeah, I think the fiscal side needs to be there. I think the market generally expects it will be there. I mean, I always use a line that's attributed to Winston Churchill. I don't know if he ever actually said it, but Americans always do the right thing, but only after exhausting all other options. So we will find out if that's the case here. My point, Oliver, is we do need to bat 3 for 3 or 4 for 4 on policy in order for this to persist. Monetary policy, all in. Reopening policy, we're learning. Again, we have to make sure that we're getting the right behaviors in place so that we can re-engage appropriately with the economy. We have to get fiscal policy right. We're going to need more funds to cushion, bridge us through this, provide support to the recovery, and obviously trade policy. The last thing we want to do is be too disruptive there, strengthen the dollar, lead to another flight to quality. And so there will be days where there's volatility in markets, when there's uncertainty around that policy. That's when volatility emerges in markets. But ultimately, I believe we will bat 4 for 4. And I do think fiscal policy will emerge to provide additional support to businesses, households, municipalities, and communities.